Hi, everybody. Today's January 9th, 2024, and I'm honored to have with me today Matthew Tuttle. He's going to tell us a little bit about himself, but we're going to be focusing on kind of the contrarian approach. Matthew, tell us what's been going on in your world and what are your interests?
So, and thank you for having me. So, my interests are in investing. I sit around all day and I trade the markets. I'm also an ETF. Yeah, I wouldn't say issuer. I call myself an ETF entrepreneur, where I come up with ideas that A, I want to trade, and B, I think other people are going to want to trade, and C, if I can call out some hypocrisy out there or some issue that nobody's taking the other side of, so much the better. The beauty of now being an ETF issuer is I can issue stuff that I want to trade myself, which I couldn't do when I started trading in the early 80s.
So what caught my attention was your Jim Cramer, your anti-Jim Cramer fund. I'm probably getting all these terminologies wrong, so I pre-apologize for my naivete and lack of knowledge on this particular aspect of the world. I'm kind of an investor, but I'm kind of a put my money there and let's see what happens kind of stuff. I'm not an acute trader such as yourself. What is the anti-Jim Cramer fund? Describe how the idea came about, what happened with it, and what's the notoriety that it was attached.
Yeah, so there's a lot of stuff there. So I in the 90s was at a couple of different brokerage firms. And then after that, I was at some insurance companies. And I saw how Wall Street treats the uneducated investor. And it's not a good thing. I could tell you story after story that are just horrific of, big, well-known, I'm not talking about Wolf of Wall Street stuff, big, well-known Wall Street firms, what they do to people. So I always tell people, look, you got to go and you get educated. So what do people do? They turn on CNBC or, any financial media. And what people don't realize is the financial media is not in the advising and education business. They're in the entertainment business. They make money selling advertisements. Who advertises on CNBC? Who advertises in the Wall Street Journal? You name the publication, it is the big buy and hold investment firms. So and I've got a bunch of these, but I'll give you a real quick story. So I was talking to a reporter at Market Watch a few months back. There was something that JP Morgan did. I don't even remember what it was, but we were talking about it. And I told the guy, look, this is why this happened. And he said, that's interesting. Too bad I can't print it. He's like, my editor would kill me. I said, yeah, JP Morgan's a huge advertiser. He's like, yeah. So, that has always been kind of my thinking about the financial media. And, and then the people they bring on are not brought on because they've identified these experts. It's some 22-year-old booker who, just finds people. And, and again, they're looking for entertainment. So fast forward to Jim Cramer. Jim Cramer has been consistently wrong. And he's got one claim to fame in his hedge fund where he was in cash. I know the story of why he was in cash. It was not because he called the market. Maybe a story for another day. But, going back to his Bear Stearns call in 2008, where he told you it was fine, and a week later they went under, all the way to Silicon Valley Bank, all his crypto calls. The thing that really, though, pisses me off is every day he's brought on with deference. And there's no accountability. You can tell every once in a while David Faber's biting his tongue. When we launched the fund, I had some unnamed CNBC people come up to me and say, hey, look, thumbs up. Just don't tell anyone I told you this. So, the people who know what they're talking about there realize it, but he's entertaining. Why is Mad Money on? I mean, I don't know if you've ever watched Mad Money. It's horrific to watch, but I mean, obviously the advertisers like it. He brings on these CEOs. They probably advertise on the network. He tells you to buy their stock. Everybody is happy. So, you see it on the internet, but nobody was really forcefully taking the other side of that and saying, hey, look, instead of bringing Jim on in the morning and saying, hey, Jim, what do you think of whatever? Also ask him, hey, Jim, we asked you that same question yesterday. You told people to buy XYZ and it went down 20%. What do you think about that? No, nothing there. So we decided we needed to start an ETF for people to bet against them because there was just no real good way to do it.
Yeah, I kind of would not mind hearing a little bit more about what happened to that fund, how it progressed. But I'd like you to also segue into, Cathie Wood's and ARKK, and maybe see if there's an underlying theme.
Well, yeah, and kind of the same thing there. So, and we're not involved in that one anymore. We sold it to another group. But basically, I was sitting around in, July of, I think it's 2021. And I had seen up through February of 2021, ARK had been up, 100 and something percent. And all the networks were bringing her on as, the next Warren Buffett and all of this stuff. And I grew up, on the investment side, in the early 80s. And in the early 80s, we had star portfolio managers. And you could have star portfolio managers because there was no internet. So if you were smarter and you worked harder, you could uncover stuff that nobody else could uncover. Today, there will never be another Warren Buffett. Warren Buffett isn't Warren Buffett. A, his performance isn't that great. And B, he's so big that whenever he does something, it goes up and he gets deals that you and I don't get. So there will never be another one. We've all got access to the same information. I can be slightly smarter than you and do a little bit better, but you're not going to have someone putting up ridiculous turns year after year. So I see Cathie's being brought out on all the networks, next Warren Buffett, and I know what's going to happen, which is what did. People are going to put a ton of money in at the very height, and they're going to lose it. So I'm sitting there over the summer, and all of a sudden the Fed is starting to talk about maybe raising interest rates. And I know what happens if the Fed raises interest rates. All the companies that Cathie's invested in get crushed. So I'm like, I need a product to go short these companies. So we launched SARK. It came out at 30. It had one trade at $29.95 and then never looked back. The performance was insane. And it was insane because exactly what I thought would happen happened. A, when the tide went out, you saw they were swimming naked. They had no risk management. They don't know how to trade. I mean, as a trader myself, and, the transparency is great. So in an ETF, my holdings have to be public knowledge. I don't have to tell you my trades every night. She did. So I give her that. I mean, great transparency, putting yourself out there. But then me as a trader, I'm looking at it, I'm like, what the heck is she doing? This doesn't make any sense. So the risk management, all that, and, all those companies that weren't making any money, they all got crushed when interest rates went up. Now they're coming back, and she's being touted as the next Warren Buffett again. Hopefully, people aren't going to believe it this time. And use it as 1, 2, 3, 4% of your portfolio if you want. But don't. I mean, I would have people come to me after we launched SARK like, "Oh my God, I put 50% of my portfolio in it. I'm down 80%. What do I do?" Like, I don't know what to tell you at this point.
Yeah, what you need to do is you need to have an IQ test for your incoming investors. Well, not really IQ, but kind of maybe if you can come up with 10 questions, that would be dispositive of people who are gullible.
Or you just need to have the media not tout. But the problem is they need star money managers. So they're always bringing these people out, and these people are always totally and completely wrong, and there's never any accountability for it.
Yeah, there's a Danish proverb which I love. It's called. It says, "Amongst all the things difficult to predict, the future is the hardest." I'm sure that Cathie Wood's got there from being intelligent, good investor, blah blah blah. There are a lot of people who get up the ladder from doing excellent work. In my world, I've got see a little MD over here. I've been paying close attention to the experts of the medical public health world because we all had to. We didn't choose to. But Dr. Fauci's a smart guy, and he worked his way up. I don't think government work is the most taxing of all the medical fields. I think ER, emergency room medicine probably is. But he was graduated, I don't know, near top of his class at Holy Cross. So he's a bona fide smart human. And he said a lot of things that were truthful on the way up. And, once he's up there, he can kind of make pronouncements. It becomes a little bit like the, I don't know if you ever saw Woody Allen's Bananas, where the revolutionary finally gets in charge and he starts making these weird laws because he can. I'm wondering, is it kind of the intoxicating, low oxygen level of being on the alpine heights of fame that get to people, or they just are listened to too carefully, or is it us?
So I think it's us, and I think it's the conflicts of interest. The only thing I blame Cathie Wood for was coming out with her predictions, where there were some times where she said, hey, and you really can't do this. And if someone like me went on CNBC and she literally said, hey, buy my fund, and over the next 5 years, we're going to average 40%. If I go on CNBC and I say that, I mean, I got the SEC at my door the next day.
Right.
Somehow she got away with that. So, making those bold predictions, A, you're not supposed to do. B, I falter for that. Besides that, I don't falter because, our business, and I'm in the same business she is, it's marketing. We get paid based on money that goes into our funds. Whether that money is going into our funds the right way, meaning someone is putting in 2% of their portfolio, or whether someone is putting in 80% of their portfolio. But also, unlike financial advisors, we don't know. If I get $1 million in my fund, that I don't know who put it in. B, I don't know anything about that person, and I don't know what size of their portfolio is and whatever else they have. So, as an ETF issuer, you just want money coming in. Yeah. So if she's on TV and CNBC is calling her the next Warren Buffett, I don't expect her to step back and say, wait a second, there's never going to be another Warren Buffett. So I blame the media, and I blame the way the system is rigged, where, again, it's all entertainment. And, and again, only to an extent, because, who's going to watch it if it isn't? I mean, if they just came on and told you, hey, here's what's going on. Okay, yawn, boring. Why am I going to keep CNBC on all day? So they've got to entertain you. It's just a messed up system. And I would say individuals need to be educated.
So I think I'm going to buy into most of all that. I would just add, I'm just curious, this is an additional kind of question or stipulation. Is it also, as we're making this soup, is it also like a little extra ingredient of political suasion? Like Sam Bankman-Fried was not just connected, but he was a cyclone of money donation politically, and I assume kind of in the broad influencer sphere, not just politically, but kind of socially, politically in a sense, and getting all the right people to say the right things at the right times for the wrong reasons, perhaps. Do we kind of favor a certain type of promotion on these shows and or in the media in general, so that is there a double standard of who can say what, like in Cathie Wood's example, getting away with things that might put you under scrutiny, and or does the media writ large kind of take a blind eye to those that might be contributing to like-minded causes?
There's a lot of that. And, at the end of the day, follow the money. So CNBC, Jim Cramer, along with, Kevin O'Leary and some others, were touting Sam Bankman-Fried. Jim Cramer said he's the next JP Morgan. Now, why? Again, follow the money. He was, paying people, political influence, all of that. It's all tied together. And, Theranos, on and on of these people who were, throwing money. And Epstein, same deal. You've got a lot of money. You get away with a whole bunch of stuff that the rest of us don't. And on the other side, and I am a fan. I've got a fund that goes long and short Tesla. I am an Elon Musk fan, but the stuff he says sometimes you're like, oh my God. But he gets away with it. They're going after him now for stupid stuff, but so he may not get away with it forever because I think he's ruffled some feathers. But in the past, he got away with a lot of things where you're like, wow, can't believe he just said that.
Yeah. No, I sympathize with that a little bit. Just curious, Herb Stein, Ben Stein's dad, was a Nixon era economist, and he said that which can't continue doesn't. And it's a pretty, it's kind of like Bill Belichick's "it is what it is" somewhat. And just as a side note, while I'm thinking Bill Belichick, I'm wondering maybe later can come to the analogy between Bill Belichick and Warren Buffett, as far as like analytics taking over the game, and somebody with good instincts on a human level may not be able to compete, et cetera. But that, getting back to the Herb Stein quote, ESG. Do you have an anti-ESG fund? Should there be one? What is going on when BlackRock, Larry Fink, and so forth can kind of make companies do things that aren't in the company's presumed at least short-term best interest?
Yeah, so I have 2 anti-ESG funds that are in filing. We are hoping they come out in April. Then I have a third that I will probably start the process of filing within the next week or two. That is a huge area of interest for me. There's some stuff out there now. I think everything that's out there now just doesn't do it. What people may be familiar with is Vivek and Strive, which is the company he started. And what Strive did is they called out the proxy issue, where you give your money to BlackRock, and then BlackRock votes proxies the way they want to vote proxies, not the way you want to vote proxies. So Vivek called it out. He's trying to fight it, but he's got $1 billion, they have $1 trillion. Good luck. It's not going to work. And he's buying all the same companies they're buying. So we filed for 2. What we filed for is a go woke, go broke ETF, where we're going to short woke companies. And,
did you just make up that phrase, go woke, go broke?
I did not. So
it's catchy. I kind of like it.
Yeah, so I do too. And again, we hope to have that out in April. And then we filed for a ETF, ticker symbol GUNZ, GUNZ. The idea is that's a personal security index from the standpoint of cities are less and less safe. So, for example, I've got one kid in Chicago. I've got another kid in New York City. That shouldn't worry me. It does. And I'm not happy that it scares me that they're in big cities like that. They shouldn't. Defund the police, all of this stuff, meaning more and more people are going to be responsible for their own security. So we've got an index for that. Interestingly, over the past 10 years, the index has crushed the S&P. The past 3, it had trailed because, different administration comes in, different policies, but also it doesn't have any of the Magnificent 7 names. Interestingly, it caught up last year, and I believe the index surpassed the S&P or came close to it. So I think you're seeing more and more money flow to that sector. So we're looking forward to that. And then I can't talk about what I haven't filed yet, but we got something else coming. I think that is a huge issue. I think BlackRock, State Street, Vanguard at this point are more powerful than anybody out there, including, which is the problem, elected politicians. The heads of those companies are not elected. They are the largest shareholder, I think, in like 80% of the companies in the S&P 500. And I think sometimes people forget companies are owned by their shareholders. When you are the largest shareholder, you basically own the company. The CEO reports to you. So, if I own 100 shares of Apple, I'm not calling up the CEO and talking to him. But if I own as much as those guys do, I can call up Apple. Hey, I want you to do this. I want you to do this. So it is a way for these companies to try to affect change outside of the ballot box. So you and I have no control. Now, you could argue how much control do we have at the ballot box, but at least we have some. I can vote. If I don't like the guy who's in, I vote for the guy I want. Majority rules. With what's going on in corporations, these guys have so much power. And, and again, they are too big to jail. I mean, you can't really do anything about it. You've just got to keep calling the issue out. And so, we're going to launch funds, and I'm going to be out there talking about this issue as much as I possibly can and making people aware. And you get enough people pissed off, at some point you get change.
So have enough people been pissed off by the exposure of the, I would like to say morals, but there weren't any, exhibited by, the triumvirate of women presidents, MIT, Penn, and Harvard. Have we reached the emperor's new clothes, no clothes point for any of these movements? And not so much that, but at what point, and will there at some point be a reverberation through the market? So, they come up with some different, acronym than DEI or ESG or SEL or whatever, that they might start perhaps to think about what is best for the company providing the thing they actually provide theoretically or in actuality. So
I think what last year did is made people aware. And it was really, the big thing I think was the Bud Light, what they ended up doing. And it really made people aware. And, and people spoke with their wallets. Now, these companies are so big, the stock price tanks, then it comes back. Now, which is why we're starting our Go Woke, Go Broke. In my mind, it's as soon as they do something, we're going to short it. We're going to make money on the downside. And then I'm a trader. So I'm not going to sit on that short forever. If I see it start coming back up, we're out of that. We'll go into something else. So I think people are now aware. And I think what that awareness is doing is driving a lot of the activity beneath the surface. So you see more and more of these headlines, companies not mentioning ESG anymore, but they're still doing it. So whereas in the past, it would be like, hey, look at me, I'm green, I'm ESG, I've got, 3 different types of bathrooms and all this stuff. Now I still have all those things, but I'm not talking to you about it. Mm-hmm. So, is that progress? Is that not?
Right.
Yeah, I don't know. But I think the fact that people are aware and thinking about this issue, I think, a lot of this stuff, Disney and Bud and Target and Victoria's Secret, I think it just got people, they're looking at it like, what the heck are these guys doing?
Yeah, no, absolutely. And, it's just, I think it was Laura Ingraham, probably 20 years ago. She had a book, Shut Up and Sing. She had paid, I don't know, the equivalent of $1,000 to see Barbra Streisand's one in her sequence of final farewell concerts. I think she had a dozen more after that, and she got out there, and Barbra Streisand did, and just politicized, and so it's like, try to stick to your core product without alienating your customers. How hard is that?
Well,
Your view.
and also, the really tough part is if I'm the CEO of a company, I'm a fiduciary. I have a responsibility to my shareholders. And what the ESG guys, they try to, it's the stakeholders. So it's society, it's the environment. It's like, no, somebody buys your stock. They're not buying your stock to change the world. They're buying your stock to put their kids through college, to retire, to buy that vacation home, whatever. If they want to change the world, they're going to make money on your stock and they're going to take it
Right.
and they're going to use it, donate it, start a foundation, do whatever.
Yeah, there's a writer I really enjoy. He's in the Wall Street Journal a fair amount. His name is, it's kind of like the Ebonics version of Ask. His name is Akst, A-K-S-T, Daniel Akst. And he wrote a book, an article, like an op-ed, I don't know, probably 15 years ago, Take Heed Graduates. And I used to send this to all the high school and college graduates I knew, because his point was, if you want to change the world, don't become a social worker. If you want to change the world, become basically Matthew Tuttle, become a fund manager, because you can take your money and then you can, make far more, have far more power to, sway public opinion, as an Elon Musk, as a Bill Ackman, as a, George Soros, whatever, than you ever could as an individual, in the world of social work or something like that. If you want to help, thousands, if you want to help Granny, become a social worker. If you want to help thousands of grannies, become a fund manager who can help them make more money so they can be better grannies, or you can take your extra and devote it however you will. But I'm wondering, you kind of already touched on that. I don't want to redo the wheel. So maybe we could just kind of go back to the concept of Warren Buffett and Bill Belichick. I don't know if you follow football much. I
am a huge Patriots fan. Would, regardless of all the issues, would love to see Belichick stay.
Yeah.
All the Boston sports guys are saying he's going. They talk to people. My assumption is he's gone, but the run he had, to me, that buys him a lot of goodwill. But the game, in some respects, with player development and like you were talking about the statistics and, in the whole idea of across sports of player development has gone to kind of that Moneyball type of approach and, all the stats and, his drafts have not been good. His decisions on who to get rid of and who to pick up, not like they used to be. And, so, and I don't know if that's the analogy you're talking about, but the game has changed. He's, up there in years, old school, and, may not have adapted to the changing game.
Yeah, no, I kind of think it's like Warren Buffett, because he was able to pick out, winners that other people didn't see. He was able to kind of go.
Now everybody can see the same stuff he's seeing.
Right.
And, in value investing, and I just tweeted about this the other day, I would argue it's pretty much dead from the standpoint of you're just not going to find hidden gems. Peter Lynch's book, One Up on Wall Street, still has some value because, you're in the medical field. There's stuff you probably know that some 25-year-old analyst, with an MBA from Harvard who's never worked in your field doesn't. But, are you going to know, are you going to be able to pick out value stocks outside of that? I would argue you're just not going to be able to do consistently what Warren Buffett used to be able to do because he was smarter and he worked harder than everybody.
So I'm curious, as an investor, how much of it is analytics and how much it is your sense of human logistics, human strategy, human reactions? I've been told that in depressions, you should go buy, alcohol stocks. You might want to buy alcohol for yourself personally, but how much? What's kind of your Bible for this? What are your sensibilities? Are you working off your own personal experience? Do you kind of pool knowledge or poll people or whatever, how do you kind of figure out what is going to be the bounce back effect? And how do you know when these experts are out over their skis?
So the experts are always out over their skis, and
that was easy.
The smart money is not smart. And yeah, I mean, you see it every year. Last year was a great example. Everyone came into last year massively bearish, way underweight tech, and massive bull market, tech took off. This year, everyone is coming in massively bullish, way overweight tech. So in that standpoint, I'm looking at the stuff they're underweight. I'm looking at commodities. I'm looking at emerging markets. I'm looking at small caps. I'm looking at all the precious metals, all of that stuff. And I'm assuming that they're going to be wrong about the overall direction of the market. For me, and again, there's a million different ways to slice it. What I always tell people in investing is it's got to fit you. There is no one right answer. There are many wrong answers. What my style is quite simply buy the fear and sell the greed. So we like to buy dips and I sell rips. So yesterday the market was up big. I got out of about 90% of my equity exposure. And, today it's going all over the place, but that's my style. I go the opposite of what everyone else is doing. When everyone is getting greedy, I'm selling. When everyone is getting fearful, I'm buying. And I've not to get too into the weeds, I've got some systems that I've developed through the years that I use, and then I also use discretion as well, because I've been doing this for like 40 years, and sometimes you look at stuff and you just know, hey, this has hit a support area, it's going to bounce. And, you see where the money is flowing, and, there are all sorts of things you can pick up when you've been doing it a while.
All right, I find that interesting. You had me kind of like searching for a question. On a kind of an investment strategy basis, what kind of key piece of advice would you offer, say, the neophyte investors who are often, swayed by popular opinions and market trends? I mean, should they just give their money to you? I mean, there are other things they should be learning, doing, picking up? What are their signals out in the world? Or should they just kind of keep with their own expertise, and leave it to experts, as it were?
So again, there's no one right answer. There are wrong ones. I think first and foremost, there are areas in your life you can delegate and not have to know anything about. So, years ago we had work done on the house, and the guy doing the plumbing was asking me, hey, do I do copper pipes or plastic? Like, Robert, I am hiring you to do this job. I have no idea. You decide what you think is best. And you know what? If he makes the wrong choice, yeah, maybe you have a leak. It's not a disaster. I think other areas, health and medicine, yeah, you've got a doctor, but you need to be educated on that stuff. Finances, you need to be educated on that stuff. I don't think you can ever just say, take your money and go to someone who you perceive as an expert and say, here's my money, go ahead and invest it. Because you just don't know. And typically, the more persuasive people who are convincing you they're an expert sometimes tend out, not to be. And you're not going to know if you don't know what you're doing. Beyond that, so again, educate it as much as possible. Whether you handle it yourself or not after that, I mean, that becomes a personal decision. I think an individual can do so much better than a financial advisor. But again, you've got to have the education and you've got to have the time. So what we've seen since, or at least I've noticed it since COVID, is you've got a massive group now of individual investors who are connected on social media. So I'm active on Twitter and I'm in 4 different Discords. I don't even know what a Discord is, but I know I'm in 4 of them. And there are retail guys, some of them who don't work anymore, some of them are work full-time jobs, some used to be on Wall Street, some were never on Wall Street. And we're talking all day, every day about stocks. A lot of these guys are smarter and know more and are better at picking stuff than anyone I ever met on Wall Street. But, they've educated themselves. And then you see from time to time people who haven't, who think, hey, it's going up, I'm going to buy. It's going up, I'm going to buy. And then you see the post of, oh my God, I just blew myself up. You don't want to be the guy who blows yourself up. So get yourself educated and then decide, do I do it myself? Do I not? Your style has to fit your personality, your tolerance for risk. I'm in and out, in and out. I have no tolerance for risk. I don't want any losses. The second something goes down a little bit, typically I'm out of it. I do not hold for the long term. On the other hand, one of my kids works for a hedge fund. He's 24 years old. He's like, Dad, I just want to put my money away and not look at it for 40 years. I'm like, all right, I can't do that. I've got to look at it every 40 seconds. If you can put it away for 40 years, you're a better man than me. And you know what? 40 years from now, you probably have a ton more than you started with. It's got to fit your personality. If it doesn't fit your personality, bad stuff is going to happen.
So I'm going to segue a little bit. The green movement has been, a big player in our kind of investment world from the top down, changing the world and all that kind of stuff. As a matter of fact, my understanding is Tim Cook recently met Mother Nature. I had never met her before. And if you saw that commercial.
No.
Oh, it's Black American actress. And she comes in, she's very, I don't know, she wasn't really my image of Mother Nature. She's a little bit more kind of snarky. Anyway, but it's like Tim Cook's going to do everything he can for Mother Nature. And I frankly think that computers have done a lot for Mother Nature because we don't print newspapers anymore, for instance. We don't chop trees down for that. We don't necessarily have to travel that much, but I don't think it's Tim Cook per se, nor Apple per se. Anyway, but you have the green movement on one end, and then you have kind of this anti-nuclear sensibility that's been governed. A lot of nuclear plants are being governed out of existence. In Germany, potentially Spain, France hasn't really thrown in the towel yet. It's hard to get nuclear plants going. I don't know. I never hear about nuclear stocks. Is there at some point? I mean, if you want clean energy, we already have it. It's called nuclear power, and it's a matter of avoiding Fukushima and 3 Mile Island, all that kind of stuff, and Chernobyl. I mean, I get it. Bad things can happen, but bad things can happen when you transport oil. Bad things can happen when those wind turbines chop off birds' heads or fall into the sea, etc. There's bad externalities for almost everything, and making Tesla batteries or all this electric car stuff. Where do you? I mean, I'm just laying this out there, and you can take it where you will. First of all, is there a nuclear ETF? Would that be a good hold? How do government regulations kind of fly in the face of potential best investment strategies?
Yeah, so a lot there. There are uranium stocks, and actually the biggest of them. I trade a lot. I typically watch it. I wasn't watching it today, and it took off, which kind of pisses me off a little bit.
I'm sorry, you should have come on my show.
Yeah, but so there are uranium ETFs that have these companies in them. Governments are huge in the whole energy and clean energy movement because you've basically got politicians with their biases and follow the money on some stuff, picking winners and losers versus a free market picking winners and losers. So last year, for example, you saw clean energy stocks tank. Why did they tank? Because they were unprofitable companies. They were relying on borrowing at low interest rates. Interest rates went up, and a lot of these companies went down pretty close to zero. Governments should not be picking winners and losers. Free markets should. I take issue with the whole kind of environmental movement from the standpoint of, you're told believe the science. And my retort to that would be, how often is the science wrong? And the science is wrong a lot. How many times going back 1,000 years have you been told believe the science and it turned out the science was wrong? So if you are going to tell me, hey, you've got to inconvenience yourself massively. You've got to pay $10 a gallon for gas. You can't drive your car. You've got to pay $60,000 for a Tesla. You're not allowed to turn on your electricity. You're not allowed to eat meat. You're not allowed to breathe. Any of that stuff, you've got to convince me that the world is going to end if I don't do these things. And I'm, N+1, I'm one guy. You haven't convinced me of that. So, those are some of the things that we may look to short in our ETF and in the right moments. But, and those are all industries and areas I like to trade. Could you buy a uranium ETF, a uranium company, and hold on to it for the long term? I don't know. I'm not a long-term guy. If I had bought, and I'm looking at the chart right now that keeps going up, more pissing me off that I missed it. But probably with this type of move, I would have bought it at 10 o'clock and probably would be fairly close to selling it right now and taking my profits. Because long term in regular energy and clean energy, who knows who's in office, what policies are they making,
right?
What are they going to try to crush? It's anything longer than a day, I got no idea.
Exactly. This I don't know if people have long enough memories, but I kind of call it the Cylindra effect. Just showering money on something doesn't not necessarily mean it's going to be carrying on. I have a fireplace at home, and I try to, I start a fire maybe every other day in the winter. And there's different methodologies. If you have big logs that are completely burnable, you may not be able to catch that. You have to kind of start with kindling and work your way up and have things burn, and then they reach kind of their own critical mass, and they can kind of carry on as a fire for a long time with very little tending. That seems to be a reasonable analogy for companies. With something like nuclear, though, there's a high threshold to captivate and to get into market. Are there any public nuclear energy companies? I mean, is there a General Electric for nuclear, aside from just kind of investing in uranium?
I would say that CCJ, Cameco, is probably the closest. The other thing, and now I'll put on a tinfoil hat for a minute, I would argue we could probably develop some sort of safe, and I would argue nuclear is safe, but other people might say, well, no, it's not. So some sort of safe, clean energy, again, follow the money. Would the oil companies ever let anything like that happen? And, they would fight that tooth and nail. And again, how do politicians get elected? They don't get elected because you and I give them $100. They get elected because Exxon gives them $1 million, right, and Chevron gives them $1 million. And, so I think there is a extreme structural impediment to any type of energy development that means the extinction of fossil fuels.
Right. Well, I don't think you need a tinfoil hat per se for this. I was a chemistry and physics major back in the day, and the chemistry part of it is that quote unquote fossil fuels, whether they're all from fossils or not, is a separate question. But these oil products are mutable. They're easily transportable. They burn nicely. They're high energy density, and they work, and they're inexpensive. So even if you mandated tomorrow that only you can only plug things in, well, guess what? All the places that make electricity would be buying gasoline to make your electricity.
Plus, what how do you get the lithium? Where do you dispose of the lithium?
Yeah, the stuff would not
people
go
forget
away.
That stuff.
And if you in some way could make a draconian rule against it, then people would just starve, and they would not have clothing. They would not have any of the insides of all their plastic products and whatnot. It all just stop. So this is not a feasible thing, but people can mandate it, and again, it doesn't really seem to work. But I had a friend. I still have a friend. His name is Eric Singer. He wrote a book that did not sell well, but did well for him because he wound up being a family office manager for one person who really loved his book. And I think it was something like Short the Congressional Effect. I don't have the title right, except it had the congressional effect in it. What he found out was that when Congress was in session, which is not the entire year, stocks did middling, and when Congress was on vacation for a reasonable length of time, stocks did much better. So he was kind of like doing the hokey pokey, and he put his foot in, take his foot out, and he kind of it's a little bit longer term timing than what you're having, but basically he proved it over a certain course of time. And the book is probably 15, 20 years old now. That if you just took your money, put it in when Congress wasn't around, and the point is that even if they're not making a law about your industry, they're all dickering about it, and they're all looking for angles, and they're all looking for with this law, this pro lobbyist, anti lobbyist, and they're all going to try to finagle your thing in order for contributions, either vote for or against something. So they in Congress and other governmental bodies, they are continually on the move. They never ever stop. They don't sleep. I mean, I assume they sleep and all that. But bureaucratically, they don't stop. And it's only when they're actually on vacation in the Hamptons or whatever that you can kind of breathe and do your own thing without worrying about stuff. And so this was kind of anyway, using that as a metaphor, are there ways of figuring out stocks that are less under governmental true scrutiny, or does that encompass everything now?
I mean, I think it encompasses a lot of things. With technology these days, I mean, you can slice and dice, everything like that if you want to. So there would be ways to study that. I have not, but there's ways to study everything. The stuff that they can do now with, putting in all of companies' reports, using AI, there are all sorts of things you can do to kind of figure out if you wanted to study something like that.
All right, we're kind of rounding out the hour, and I'd like to hear your overall thoughts. But mentioning AI and kind of is AI going to replace Matthew Tuttle, or just kind of the general coterie of capital fund managers? Should we be investing in AI? Is there an AI short strategy? Maybe you can touch on some of those concepts before maybe giving us your final thoughts.
Yeah. So, I think AI is going to change the world. I've got 3 kids in their 20s, and I'm always telling them, do stuff that's not replaceable. Because if you're not adding a ton of value in some way, shape, or form, a computer is going to replace you at some point. Is a computer going to replace most money managers? I would say it is. What we do is different. I'm not, I manage my own money, but, our funds have specific, metrics, and we tend to do different types of things, first of its kind types of things. So I'm not worried about AI personally. But if I were a money manager and most active money managers are basically, closet indexers, where they're not deviating much from their index. They're adding very little, if any, value. They're going to be replaced by AI. They're going to be the first people to go. Analysts, probably. A whole bunch of stuff is going to be replaced by AI. It is the future. There is not currently a short AI fund. We have one on the shelf that we did file for. We haven't launched it yet because I'm not sure what the interest would be. But what we did is we created an index of the emerging AI companies. So excluding what we call Fang and Friends. So no NVIDIA, no Microsoft, no Google, no Apple, but the next kind of generation of companies. And we've got ETFs again off the shelf. We've got a long and we've got a short version that, we'll see. Once I decide to flip the switch, I could probably have them out in a month. I just, being a smaller ETF issuer, I want to make sure there's demand before I do something. And I'm not 100% sure there is. I think if you are a longer term investor, do you want to try to figure out who the winners and losers are going to be in AI? I think you do, because I think that's where a lot of money is going to be made. as a shorter term investor, do I trade those companies? Yes, I do. And, I think that is, that is this generation's.com.
I like that. I would be remiss in not kind of addressing some of my angel questions. The raise in interest rates, if you can bear with me for a little tiny bit, it seems to have strangled a lot of the startups. I don't know if you have a thought about the startup world, markets, angeling, that kind of thing, and what might be the pitfalls. What are the prospects?
I mean, I think it depends. And, in the ETF world is the same thing. I mean, if I can come up because I'm a startup. I mean, I'm the sole owner of my company. I've got 3 employees, 4 including myself. And, we're a small shop. So we've got to add value. I've got to have something that's different. I've got competitors that are much bigger, have many more people, have money to burn, and I've got to somehow figure out a way to compete against those guys. And I see smaller ETF issuers all the time. I see some fail. I see a lot fail. And I see some successful. And the ones who are successful have figured out, all right, here's how I carve out a spot for myself. Because I'm not going to compete head to head with BlackRock and Vanguard and State Street. And if I try, I'm an idiot. I'm going to lose. But if I can carve out, where are those guys not? Where's the area of white space that I can carve out for myself? And what's my moat? What keeps BlackRock, State Street, and Vanguard from saying like, oh, wow, Tuttle found that area. Let's go. Because I don't want, they can launch something with a 5 basis point fee where I've got to have 75 basis points. They'll kill me. So, and I think that applies to every single startup out there. What white space are you going to find? What's your moat? What's keeping someone else from competing with you? And then how are you going to market yourself? How are you going to get the word out in a crowded space where, I'm bombarded by, I think I get like 1,000 emails a day. How are you going to let me know that you found this one space that maybe I'm interested in? So yeah, you've got to find it, but then you've also got to let your potential customers know it's not easy. So I think most people, and I see it in the ETF space, most people fail. But every once in a while, someone figures it out. And hopefully, we've figured it out. But I got to work my butt off every day to make sure that we keep having it figured out.
Well, thank you very much. I'm going to just kind of post up here your Twitter page, and that has a link, I assume, to your web page as well.
Yeah, everything's up there.
Fair enough. And so people can follow you at Tuttle Capital at Twitter, and then there's Tuttle Capital Management. And I assume it's Tuttle's all the way down, right? So the last thing I'd like to do is just as a self-promotion, I'd like people to maybe just take 1 second here and show people if they want to help support my video cast, they can go buy my book. It's Overturning Zika. It's nothing to do with finance, but it is interesting. If I had money and I could short a disease, I would do this for Zika. It was a big pandemic in 2015-16 and then completely disappeared, and none of the theories have changed about it. I think Zika is a real but rare virus. It's a dengue. There are 4 dengues. They're named 1, 2, 3, and 4. And Zika is probably effectively the 5th dengue, never a human problem. And microcephaly is a real but very rare syndrome without any specific cause. Maybe 1 in 500 babies or something like that, and potentially in the severe cases intellectually undeveloped as adults. But it just so happens that presumably one doesn't cause the other. And if this were the market, I think people would already have just like de-invested. on this, but it's science, and that seems to have a lot of silos of supported knowledge, as it were, what's called science, but is really probably more in the realm of religious dogma. Anyway, that's my word on that. It's a great book. How do I know it? Because I read it and I wrote it, and it's frankly a fascinating Sherlock Holmes approach to an illness. And obviously, you can make analogies towards if you remember this, we had some little pandemic a few years ago as well. So, any last words, Matthew?
Again, I just go back to telling individual investors, educate yourself. Wall Street is not a kind place to the uneducated investor.
I agree. I've had on George Gilder a couple of times, and he's an interesting man, economist, futurist, and his basic premise is that our wealth is knowledge. The cavemen had silica. The cavemen had electricity in the form of lightning. The cavemen had solar energy potentially in the form of plants and whatnot. What we have different from them is we have knowledge, and cultivating your knowledge is the form of wealth, and plus it's oftentimes fun. So you've provided me with a fair amount of knowledge. I'm not going to necessarily transfer any wealth to you during this podcast, but I am interested in your products, and maybe we can talk about that offline.
Sure.
All right. Well, thank you very much. Have a great day.